Hi, John.
Good morning.
Good morning.
Oh, no, afternoon. Yeah,
It is technically afternoon, I guess.
already. Yeah.
All right.
How are you doing?
Good. I'm just doing it from the house since, and it was giving me some technical issues because it didn't recognize the IP address from the house. It's so weird.
It is. Yeah. Um, I know. Why should it be that difficult this day and age?
Yeah, I'm like, okay. So then it was sending a password to an email that I don't monitor. So I had to find who's monitoring it.
Oh my
Anyway,
gosh.
I made it.
Yeah. Yeah. Well, I'm wondering, since it's a different Friday, I'm wondering how many people
Yeah,
realize
well,
that. Do
I
you want me to see if Kristen can put out an
Well, I
email
see,
blast?
and maybe it's because I wasn't on it, but I see other people joining. So,
Oh, good. Good.
all right, let me try to
Yeah, I'll
turn.
let you focus. I'll quiet down.
Just trying to get to Market Monitor. Can you see, Sean? Can you see Market Monitor?
Yes, I can. Sorry,
Okay.
I was on mute.
You're fine. So I'll just give another minute and then I'll just get started. And there's always a recording. So.
Fortunately.
Yeah, I know it was an off Friday, but last Friday being Good Friday, I figured nobody would be doing it. So.
Right. It would have been a no-win situation.
Yeah. So, yeah, here comes Joanne and Kylie. All right, I'm gonna, and stop me with any questions and I'll try to pay attention to the chat, but this is meant to be, a joint session, so feel free to input as needed. So I'm just gonna go through, hi, Joanne. I'm just gonna go through, our typical market monitor here, and this is very interesting of what's happening here in Charleston. So here we are on median sales price. So we're actually up year over year, 4.7%. So keep in mind, so 403,075, what they're comparing that to is last March where we were at 385. So we're up 4.7%. And if you look at a 50-year window, the typical market on the US basis is right around 4.7, 4.8%. So what Charleston has experienced in the past year is very typical. That is the average over a 50-year window. So nothing, if you look at a snapshot in time, that is very normal to go from 385 to 403. So how do we, and you can see the jump from February to March, pretty significant from 386 to 403. But again, on a seasonal basis, you watch the prices go up January to June that is normal. So even if we go back pre-COVID, the typical trend is you're going to go up on prices over the summer. So if we look at February of 2019, so pre-COVID, we were at 266, we went to 275. Maybe not quite 4% in a month, but I mean, that's a pretty significant increase. And then we peak out in June. So I expect a lot of this, what you're seeing in here, was driven by COVID. The price increase was going above pace. And then we had the crazy first quarter of last year. This is not normal to go from 360 to 425 in a 5-month window. So what we're looking for is a return to a normal pattern. So if we've gone from 386 to 403, what's going to be interesting is, okay, next month is April. Last April, and I'm just trying to forecast ahead of what the media is going to say. Last April, we were at 400. So if we go from 400, are we going to be, the big question is for next month, are we going to be above 400 or below 400? Again, I can't see anywhere where we're below 400. If we're at 403 in March, I don't see where we're going to be below 400. So next month should still be a positive increase. Maybe not 4.7%, but I think it's still going to be positive. So here comes the big questions, May and June. So May of last year, we were at 425. And then in June of last year, we were at 420. So April, I think we're going to be positive. May and June, are we going to beat 425? I'm not sitting here saying yes, but I'm also not saying no. Like the market is certainly very active right now, and houses are getting absorbed quickly. And I see multiple offers. Can we get from 403 in 2 months to 425? I don't know, and we might not. But I think what we're going to see is maybe these 2 months we don't beat it, so we might go negative for a couple months. But if you fast forward to July, 399 last July. If you ask me today, are we going to be above or below 399 this July? I can't see where we're going to be below that. So I feel like we have a window of time of maybe 2 months where this number might flip negative. And then you'll get the pundits saying, oh, look, house prices are going down. Well, house prices aren't necessarily going down. What happened is people probably overpaid in May and June of last year, when there was nothing for sale and people just put whatever they wanted on a contract and got it to closing. It's more of a matter of people probably just overpaid. And this is probably the normal trend that we're going to see. But I think once we get past those 2 month periods, I think we can start progressing on a positive direction, just like we did in March, 4.7%. I don't see where that's not possible. And I'll show you why I feel that way with some of these other numbers, but this is going to be very interesting the next 3 months. I believe April will be positive. May and June, I think the jury is still out. I don't know what's going to happen. It's going to be close. So even if it's negative, it's not going to be a big negative number. Think about it. If we come in at 420, on a 425, we lost 1%, right? That's not, if that's our low point, that's not the end of the world. Price per square foot, this has been kind of going sideways for a year now. If you look at it, it's kind of progressing sideways. And I think this is kind of, people are not, they're watching more what they're spending on houses, and they're calculating price per square foot, and they're just being more cautious. So this is much more of a flat line that you're seeing, kind of a sideways movement. It's up year over year, but kind of maybe even drifting down a little bit. But again, that's price per square foot. People are going to more focus, and the media is going to more focus on median sales price.
Anton,
yeah.
Would you mind looking on this and the sales price and the per square foot, the new construction versus existing?
Yeah, so here's new construction. So still kind of, up year over year, but relatively flat. I mean, if you look at right around 200 a square foot has been where we've been at for a year. And if we go to previously owned, you can see also flat,
I guess it is, yeah, but it's
been
trending
relatively flat for a year. So that's very interesting, and we'll see how long it takes before that kind of, maybe we go flat for another year. It might kind of take a while to start going and heading higher. But here's, as we go through this is what's telling me we're not in a market where the prices, again, year over year, there might be comparison, but where prices are headed. Look at the median percentage of original list price, right? So for a while we were at 100%, which means half the houses were selling for over 100 and half were selling for under 100% of the original list price, not final list price, original list price. And then we fell off the cliff when the rates went up. So from August, we were at 100%. We went all the way down to January at 96.5. Now keep in mind, when are the January contracts that are closing were written in Thanksgiving, Christmas, New Year time period. So that's not abnormal. If you go back to 2019, look what happens. Higher going spring to summer, lower going fall to winter, higher, lower. This is a normal seasonal pattern. Forget all this. This is all COVID time. I mean, nothing made sense here. So this is a normal pattern, but we are jumping, and we've gone from 96.5 to 98.2. So this is a couple factors happening at the same time. One, sellers are pricing their homes more realistically than they were in here, right? Builders were reducing their prices in here, right, to get rid of their inventory. So that's another factor that was dropping here. and we're shooting back up. Are we going to get to 100? I don't think so. But, we will see this same pattern, and maybe by May we're peaking out. So maybe we have a couple more months, maybe we peak out at 99%. But this is returning to a normal seasonal pattern, and it's showing me the market is strong enough that sellers are pricing more realistically. At the same time, buyers are paying because it's available and there's multiple offers and they want to not lose it. So they're having to pay close to list price. If we look at the days on market, we were going up again, rates went up. What happened? Days on the market, higher, 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 higher till February. Well, when are those contracts? Again, Thanksgiving, Christmas, New Year time period. So we peaked out at 25 days on the market as a median. So remember, median is half the houses are taking more than 25 days, half are less than 25. But then look at the last, we fell off in March to 14 days on the market. So we went from 25 to 14 in 1 month. And again, if we go back to 2019, let's say, because that's the last kind of non-COVID year, if you want to call it that. Look, February was the high, 34. What happened the next month? Drop, drop, right? So what's happening now? Drop, probably another drop, right? This is normal. Go back to 18, drop, drop. So forget all of this, right? Look back to what normally happens. And we're going in that spring, we are in that spring market. And the days in the market plunge like they normally do, and then they drift higher the rest of the year, right? So we are in that peak, and look at this as the inverted, we're at that peak quickest to sell period right now, right? So April and May will probably be somewhere in here. I don't think we're going back down to 3 days, but we're going to hit maybe 10 days on the market. So that's a pretty quick market historically based. If you look back at 18 and 19, we were sitting between 15 and 30 days on the market, and then 35 days on the market. So we're still below pre-COVID numbers from how quick homes are selling. If we go to months of supply, so look at months of supply. We started going up when rates went up and when the winter came around. And now what are we doing? So since November, we've gone down, 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 down. So that's 5 months in a row we're heading lower. Now, sure, you compare it to a year ago. If you go back to March of 2022, we were at 0.8. So we're twice as much. That's the plus 100%. We doubled in a year. But historically, I still want to put this in reference, 1.6 months of inventory. This is, and again, I always say this, is that if I only know one statistic, it's months of inventory tells me a lot of what's going on. And again, pre-recession, the lowest we got was 3 months of inventory. So pre-recession, for those of us who were in the business back then, was a crazy moment in time in activity. And we were at 3 months of inventory. We are half of that. We're at 1.6. We're half of that today. So our market is twice as fast right now as it was pre-recession. Now let's go to the recession. We were at 17 months of inventory. So anybody who says like we're in this bubble and housing crash, we had 10 times the months of supply we did in the recession. 10 times. This is not a recession duplication, right? And then it took us years to work through that inventory. And then we hit stability, let's call it, at about 4 months of inventory. So pre-COVID, we're still less than half of what we had pre-COVID. So every indication is that we're still in a very seller-driven market right now compared to historical references. And again, nothing's going to compare to 0.7 months of inventory a year ago, right? When you have 900 homes for sale, then this is what happens. Well, we're not going back down to 0.9 months of inventory, but we're hitting that seasonality again, where we'll hit a low at some point, and then in the fall and winter, we'll start to go back up, but it's still going to be a very low number relative to historical perspective. Homes for sale. We hit a peak in November and we've gone down, 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 down. So we are higher than a year ago. Yes, we have more for sale. But when I look at my wall calendars that I keep track of, you can see that seasonality returning back in here. I think there's a chance by the time we hit the third and fourth quarter, let's say even say third quarter, I think there's a chance that we're going to have less for sale in 2023 than we did in 2022. So this number might flip negative by the time we hit, let's say, September, October. And there's a lot of reasons why that's happening. And the main one is the seller motivation. You know, these sellers have homes that they own at 3.5% at a low tax rate. And the thought of them moving is what's keeping them off the market. And that's why we're having a really hard time getting back to, I'm going to call it a normal amount of inventory, is around 6,000 homes. You know, 2018, 2019, we're around 6,000. We're not returning there, you know, not real quickly. You know, so it's going to take some time to get back to here because you have to motivate sellers to sell their house, right? And if we go back, let's just flip back in time on this one too. We had 12,000 houses for sale in the recession, right? We have 2,500 today. So we have 20% of the homes for sale with 50% more people living here, right? So think about that for a second. Are we in some sort of recessionary period that the media likes to promote? No. We have 50% more people living here today with 20% of the homes for sale. This is no comparison to what was happening back here. And I know not all of you were in this business, but I see Joanne on the call was. This was a completely different time period and a completely different scenario. So we don't need to compare it to here when you look at the numbers. Let's zoom in again. So closed sales. So closed sales, 1,597 in March, off 25% from a year ago, right? So we're down from a year ago. But historical reference, if you go back to 2019, we sold 1,578, right? So what are we, 1,597? That looks very similar to 2019. Now, it'll jump, remember, from January to February to March to April to May. It jumps, and June is typically the highest month. So we're on that upward trend. Where are we going to peak at? I mean, maybe we get to 2,000. You know, it might look like these years here, but we're returning to that normal seasonality and normal amount of volume of sales. So we're off 25% year over year, but as we go forward, those comparisons, once you get to the fall, I think we could flip positive here, or at least break even again as far as year over year comparison with the number of sales. New listings. So yes, March we jumped 2118, right? So, but 8% less than a year ago. So a year ago, March, we listed 2,303. So still harder to find the sellers. And in this, you don't really notice much of a difference here, right? So look at the trends. COVID didn't really kind of mess with the number of listings hitting the market. It looks very similar. But I'm going to go back in time and watch the jump, right? So December, nobody lists. January, some people start hitting the market, right? February, and then you go up to March. So I want to show you guys, like, March was the peak in 18. March was not the peak, but close to the peak. So March, April, May are the highest 3 months typically. Here's COVID, so it's kind of hard to show you that. But here's March, April, May. June, July was big this year. But these are COVID years. I don't necessarily trust exactly the data here. But March, April, May are typically your big listing months. So where are we at? There's March. What do we expect in April? We're halfway through April, right? So April, May, these are our peak listing months. And we're having a hard time keeping. So think about it. We're listing a lot of properties, but we'll flip back to this one, but we have less for sale, right? So if you're listing properties and you have less for sale, there's more buyers than sellers is what that means. If your inventory is dropping, your buyers are overriding your sellers, even in the peak part of the year. So we listed less this year than a year ago. So check out the pending sales. So pending sales, if we look at it, So we had at the end of March, we had 1,887 pending. So that's off 6.8%. So remember, our closings were off 25%, but our pending is only off 6.8%. So that's a sign that the market is recovering from the lower closings, right? If you only are missing 6.8% pending, and again, March 1887, if we go back to 2019, we had 1,830. So pretty close. And typically when you look at the peak, here's May was the peak here, kind of April, May, June, or March, April, May here. So we're getting close to that peak period. Remember, this was the delay with COVID, so I don't know if necessarily trust that. But if you look at last year, March was the peak, with April and May still being strong. So we're going to peak out here, and it's going to look probably similar to these 2 years, and not that dissimilar to this year. Now, I think once you start looking at this fourth quarter here, we only had 1,095 pending in December. I think once we hit this window of time here, we could flip this to positive. We'll have more pending this year than we did last year, because this was such a drop off because of the jump in interest rates.
Yeah, but that's
Dollar volume. So we're off 20% on dollar volume, right? So, but look at where we're at, 930 million in sales. Let's go back to 2019. Did we ever hit 930 million? No. Right? Did we hit an 18? Nope. So typically June is the highest closing month, which will tend to translate to the highest volume. So we're still a couple months away from hitting, we still have to get the April numbers, the May numbers, the June numbers. We're still going up. So we're going to, pass $1 billion again. And it'll peak out, right? It's going to peak out at some point for the seasonal basis and then start this trend. But these trends are so much higher than they were pre-COVID because of prices. So, just keep in mind, even though this is off 20% from a year ago, I still think we're going to start to flip some of these positive once we go through the third and fourth quarter of this year. One interesting thing here is shows to pending. So shows to pending, and again, I'm going back to 1819. So if we use these as pre-COVID years, where were we? We're like, bottoming out at 9, topping out at 12, in this range here, 10, 11. So this is number of showings before a house goes under contract. So those of you with listings, very consistently, if you're 9, 10, 11, 12, somewhere in that range, you should be getting a contract, right? Again, kind of, here's the crazy moment when nothing was for sale, right? We had 900 for sale, so everybody would run and look at the only houses for sale. Don't take this as, going to happen again. And then, interest rates mess with us, so this was kind of low. But if you look historically, if you're hitting 10 to 12 showings, you should be getting a contract no matter what the market is. Go back to 13. Where are we? 10 to 12, right? Every month, very consistently. So if you've got 20 showings on a listing, you're not selling, what's that the market telling you? The market's telling you you're priced too high, right? So this is a great, stat to take to your sellers and say, look, historically, the Charleston market, if you're hitting between 10 and 12 showings, you should be getting a contract in your home. That's what the market historically, over the past decade, COVID, non-COVID, doesn't matter. This is where we're at. So, it's a good thing, and especially if you're going on listing appointments, put that expectation up front. If we get to 10 to 12 and we're getting, maybe no close calls, second showings, and nobody making an offer, the market is telling you you're priced too high. Shows per listing. So this is saying in a month, so in the month of March, the average listing was getting 7.3 showings. So not quite, but almost 2 showings a week, right? This again, the peak of 11 in February of 2022 was because there was nothing for sale. So everybody would run and look at the same thing. But if you look at historically, again, you can see the seasonality, right? Here's the seasonality. But if you look at historically, if you were getting one showing a week as an average listing, that was about it. We're still getting close to two, almost two showings a week. So we are still showing more traffic than we did pre-COVID. But again, this is seasonal too. We will peak out and start heading the other direction. So, everything is telling me we have this kind of moment in time, and let me zoom in a little bit. We have this moment in time where last spring, when we were hitting 420 and 425, right? These 2 months here were the peak moment of the least amount for sale with the highest buyers, right? So that absorption, if you look at the months of supply, that absorption back in was 0.8 months, right? So this is what drives prices higher when you have, it's all supply and demand, right? I don't care what anybody says.
Right.
I know there's a lot of things happening in the world, but it all funnels down and it all can be shown with the months of supply. This is a gauge of how many sellers are out there compared to how many buyers. And this is telling me there are not many sellers and a lot of buyers, especially when you go back historically. And we are still only 1.6 months of inventory. I know probably most of the things you read, it says 6 months is the dividing line between a buyer's market and seller's market. I think that's a little high. I think 4 to 5 months is more kind of a neutral market. So, I felt like historically, if we look back in the 10 years, if you go back to 16, 17, 18, 19, in that time range, that's about as normal of a market as I've experienced here in Charleston. It's about 4 months of inventory. So I think that's kind of an even playing field where a buyer can look at a house, go look at it next week, think about it, make an offer, negotiate, ask for repairs, a normal transaction. That's what was happening back in here. Nothing's been normal in here. So, and again, for a reference point, we had to work off our inventory, and if we're saying 4 months of inventory was about normal, it took us 7 years to get from here to here, right? So that was 7 years of working off inventory. And it only took, basically you want to say 3 years to build it up, and it took 7 years to go through it. But a lot of people on these new construction, they were probably in the field or in some lower level management when this happened. So they were so bitten by this that they're not overbuilding and oversupplying the market here. This is not an oversupplied market. Even if you look at the new construction.
Anton, your point about 7 years to build it up, 3 years, or 3 years to build up, 7 years to work it off.
Yeah.
It's conceivable that will be the flip for where we are now, right?
Right. Yeah.
3 years to, yeah.
And so if you look at the new construction, so they're 2.3 months of inventory, which is still and again, let's go back in time. So new construction got up to about 10 months of inventory in the recession, but you can see here was the normal period, right? They were 4 to 5 months of inventory, right? And then COVID happened, they got down to 1.3, went up in the fall when rates went up. But what's happened, if we zoom back in, what's happened is they've worked through their inventory, right? They dropped the prices, they sold a lot of their inventory, and it's been disappearing again. So and again, this will return to seasonal. We're not going to go to zero. March, April, May, June, it'll start to seasonally slow down. Mm-hmm. But if remember the total number was 1.6 months. So if 2.3 months is new construction, check out the previously owned. So 1.4 months. So 1.4 months of inventory is historically, again, it's below anything we experienced prior to COVID. And it's half of what we experienced back pre-recession. So, it is still a very heavy seller's market, in my opinion. And if a house is sitting there and not selling, it's simply the market saying you're priced too high. And again, if you look at the days in the market, we're down to 12 for previously owned, right? New construction is at 27. So previously owned, it should be, and again, 10 to 12 showings, 12 days in the market. So if you go through 10 to 12 showings, or if you've been on the market 2 to 3 weeks, that is the market telling you you're priced too high if you don't have a contract. So, it's a good reference point depending on your sellers or who you're working with. And buyers need to realize, maybe they're reading some articles, but it is still a very heavy seller's market if you only have 1.6 months of inventory. And the prices, again, watch the media the next couple months, they might, and on a nationwide basis, I think it's going to probably flip negative. You're going to have some areas of the country, maybe like California, that might be more negative than we will be. And we might flip negative for a couple months, but that's going to be a short-lived phenomenon. I just don't believe we're going to be below 395 in August if we're at 403 now. And again, a lot of things happen in the world, but as long as rates don't go up much. Now, what's scary is if the rates come down significantly, we're already in a seller's market. And if we drop the rates, we could get into, again, more bidding wars and just an undersupply of the market. Because even if rates go to 5.5%, that still might not be enticing enough for a seller to drop their 3.5% loan to go to a 5.5, but it might be enticing for a buyer who doesn't have a house to try to jump on something. If they were making offers and losing at 6.5%, it's even more enticing to try to buy a house. So there's a lot of dynamics at play right now, but we're definitely in this spring market. And you can see it in all the statistics, no matter what you look at, it's showing that the market is definitely a healthy market for sellers, and it's still very challenging for buyers. I find myself, my bigger problem is finding homes to show. And then when one comes on, it can go off just as quickly. And sometimes it doesn't even matter the price point. Anybody have any comments, input?
Do you think is someone else talking? Let them talk.
Yep, go ahead.
Do you think, okay, do you think that some sellers are sitting longer than historically without a price reduction, just knowing that there isn't much competition?
It's so hard to get a perspective of what's happened the past 3 years, because the past 3 years, let's go back to the days in market. And again, even for me, it's hard to remember. It's
and
like
also for pre-existing.
It used to take, even if we go to previously owned, it used to take 30 days was sometimes normal to sell a house. And sellers, when they don't sell within a week, are like, why is my house selling? Right? So it's all perspective. It's like 30 days was not that abnormal. And again, that's the median. Half of them are taking longer than that. But when you get down to 12 days, and again, a seller waiting a month seems like a long time, but it's really not as long as what it might have been in the past.
Right.
And it's hard to blank out the last couple of years, and realize that was not normal. And Joanne's making a point is like, I think you have a lot of owners of properties who by default are becoming landlords, not because they want to, but it's like, well, I'm not going to give up my 2.5, 3%, 3.5%, and look at the rent I can get on it. And maybe they don't need a down payment for another house, or so anybody who has a really low rate is going to be very reluctant to give that up. Meaning they can hold on to the property and keep it as an investment, or they're going to renovate the house. I mean, the renovations are still, I know up and down my street, it's like there's contractor trucks everywhere, because if you've got a 2.75%, it's cheaper for you to either get a line of credit, or if you have the money, it's like pay a contractor to renovate the kitchen or add a bedroom or do something to keep you in the house and keep that interest rate. So I think we're in this, and I've been doing this 21 years. I've never been in an environment where the rates have doubled in this short of a period of time. So I think what we're going through is a demotivation of sellers because of the fixed payment. I mean, the best way to fight inflation is to have a 30-year fixed mortgage, right? That's a great way to fight inflation. Your highest cost item is fixed. I mean, granted, you have insurance and taxes and stuff, but and I think I pointed this out before, my taxes went down in Mount Pleasant the last 2 years. And I truly expect them to probably go down next year again. And it's because we are selling houses at such a high price that the revenue coming into the county and the town are more than what they have budgeted. So they drop the millage rate and drop the taxes. So if you're talking to somebody from Connecticut that's looking to buy a house here, taxes went down the last 2 years in Mount Pleasant. Ask them what their taxes did in Connecticut over the last 2 years, or California. Which way do you think they went? So it's all great talking points for people from outside of this area, is that, you know, we're definitely a low-cost tax, property tax state already. And if you tell them property taxes went down the last 2 years, they won't believe you, but you can show to them it actually did.
But they continue to be surprised by our insurance. I mean, everyone's in shock, even locally, but especially from far away.
Insurance is certainly, you know, our kind of little, hopefully it's a moment in time where we have a lot of insurance carriers that are pulling out of the area, and it's limiting the options for homeowners and buyers. So they can kind of charge what they want to take the risk. So it's something that you definitely need to put on your radar for buyers, is you might have to do a little bit more homework shopping for insurance. Because, you know, my carrier where I'm at in my house, they dropped coverage. They just basically pulled out of South Carolina completely. So I had to go find a different carrier. It's not like I had an option. I didn't even have an option to pay a higher price. It wasn't even an option. So, you know, that's one thing we'll have to watch, especially along the coast, is the insurance costs. But overall, I mean, if you have a fixed payment and you know, you're just dealing with taxes and insurance, it's certainly a great way to fight inflation. And I mean, rents aren't certain. I don't see where rents are going down. You know, they still seem really high. They can't keep going up forever, but you know, as somebody who needs a house, you're either paying rent or you're paying your mortgage payment. And when you look at how much, you know, rent is compared to your mortgage payment, you're going to stay put. Did I hear Jackie earlier? Did you have a question?
Well, because I still have buyer clients saying, you know, prices are just so high. Is my return on investment going to be there? And I have told them, just like you said, Anton, look, if you can afford the monthly payment, if you're comfortable with the monthly payment, it's always a good time to buy. I mean, they keep thinking, so I guess my question is, so what if there is a recession? Then that means, like we've been told, when there's a recession, interest rates go down.
Correct.
Then more buyers are going to jump in. And just like you said, and even the people, like I have, let's say, for instance, I have a family that is in a townhome right now. When they bought it, they didn't have children. Now they have 2. Yep. They're going to, regardless of if they've got 3% interest and they've got to bump up to 5.5% or 6%, they're still going to do it, mainly because that need is still there. I mean, they need a bigger place.
Yeah. And again, if a recession does happen, then typically your unemployment rate goes up, right? But we're starting from a very low unemployment rate. So even if unemployment goes up, typically, you know, unfortunately, the people who are losing their jobs, more of them are probably tenants than homeowners, right? And even a homeowner, if they lost their job and they have no savings and they can't make their payments, what are they going to do? They're not going to go into foreclosure, right? This is not a repeat of a recession. You know, back in here, we had people negative equity on their homes, losing their jobs. So what are you going to do? You're going to camp out your house until the bank kicks you out. That's what was happening back then. Right now, if somebody lost their job and they have no savings, they can't find another job, they can't ask family to help pay for it, they can't, there's no way they can make a payment, what do? You stick a sign in your yard, you sell the house, right? Because you have so much equity in that home that you're not going to walk away from that equity. You're not going to let the bank have the equity, right? So we're not in a position where we were back here. So the US has a record amount of equity in homes right now. That was not the case back here, right? There were so many people that were negative equity that they had no desire to maintain their home, make their mortgage payments because they had no equity in their home. They were negative. It's a completely different story. So even with the recession, if that does come our way, and we do start to experience higher unemployment, again, people still need a place to live. If rents are high, one thing to watch is the rental market. There's a lot of apartments being built in the US, and do they start to flood the market, and that puts some pricing pressure on the apartments? If pricing pressure does start to show up in the rental market, then at some point, if those rents come down enough where somebody's like, well, at today's interest rates and today's house price, this is my payment is $2,500, but I can go rent an equivalent place for $2,000. Then you could start to see the buyers kind of pull back a little bit and choose to rent instead of buying. But they have to do one or the other. And it's just watching the rental market is important for us as real estate agents, because if there is a flood of inventory of available rentals, that eventually will affect the sales at some point. Commercial, so I see Joanne making a comment on the commercial markets. So commercial is it's very interesting times right now because of the work from home, and you have some of these massive cities. I'm not saying Charleston, but some of these massive cities probably with quite a bit of vacancies. I mean, if you look at San Francisco, probably New York City, the commercial markets are probably, I'm not in the commercial side, but, reading some articles, it's like they're trying to figure out what to do with those. Because no matter, even if some businesses go away from work from home, they're not all going to do that. So I think you're going to have a lot of commercial space that's going to be available. But again, those are different loans that aren't through Fannie Mae and Freddie Mac. Those are, the private, local lenders. So I don't think that's necessarily going to spill over into the residential. I think that can, be separate and not necessarily affect the residential real estate.
It wasn't Joanne's question, but at some point though, those conversion in the big cities, the conversion of the office buildings to residential, the longer road, harder to do.
I think they're going to start converting
retail.
some of these, to Sean's point, some of these office building complexes are going to turn residential.
Just like retail got converted to different. Yeah.
Yeah.
But it's a ways out, because apparently it's what makes sense. It's harder to convert office buildings to residential.
Yes.
Yeah. But it will happen.
Correct. Agreed.
Yeah. Anton, how do you have any clear measure to track what rents are doing locally? I just feel like with so many multifamilies coming on, and to Joanne's point about sellers continuing to, or staying on it and renting rather than selling.
And this is the frustrating thing to me, and I don't think it's an easy problem to solve, is, you see here we have residential and land. It's like, I wish we had rental, right?
Yeah.
And we look at these numbers from a rental, but there's two problems with that. First of all, they don't have it. Second of all is the rental market is so scattered on tracking data, right? Think about when you have a client coming to town, maybe they need a 3-month rental. How hard is that to find? It's so hard, right? Because there's not a central source. Oh, look at Zillow, look at, these other websites, look at Signs in the Yard, look at MLS. It's like, there's so many different sources. So it's hard to track. I do read on the building permit. So, and this was a couple months ago, there was a record number of apartments under construction in the US at one time. So there's 900, I could be wrong in the number, around 950,000 apartments being built. So there's a lot of apartments in the pipeline coming our way. And you can see it look at downtown Charleston.
Right.
Those, when you come across the bridge from Mount Pleasant, those two massive buildings, like,
Mhm.
well, how long is it going to take to fill those? You know, and you look at still the number of cranes that are downtown, and it's like, how much are we building for how many people are going to be here? So I think there's a time lag for, because think about it, most of these developers, yeah, they're looking, but are they really saying, oh, well, we have 950,000 in the pipeline? They started these projects years and years ago, right? They're
Yeah.
not gonna stop the progress, right? They're gonna finish these and have to fill them. And it'll be very interesting to see in the next year how many are going to get absorbed. And if they don't, then they're kind of competing with each other. And how do you do that? You got to lower your prices. Right. So it'll be very interesting to see what the apartment, rental market does in the next year or so. And I know people rent single family homes, but what the apartment rental market's going to do. But unfortunately, we don't have something this informative for the rental market. And I really wish we did, but because it will affect us. We don't have a really good way of tracking it.
I wonder if there's maybe I can ask the people at Island Realty that do the long-term rentals, like if they have a source that they go to where they can check it.
Yeah, Jackie, if there's a central, and even if it's like a nationwide number, like if there's data like this, even on the nationwide, we're part of the nation. It's going to look somewhat similar.
Right. I'll ask them and let you guys know.
Yeah, that would be great. I was just playing around with this. So this is.
I was wondering if the chamber tracks it, anything like that.
Yeah, I think
I might give them a call.
Yeah, I think we can find some sources. I just wish we had something local to our MLS.
Oh, yeah. Yeah.
So, and here's, I'll finish on this note. Here's foreclosures, right? So I just clicked on foreclosures. Obviously, foreclosures are mostly previously owned. So here's the foreclosure. So I'll go back. We only can go back to 2004, right? So here we were pre-recession, plodding along. You might have had 20 foreclosures a month. Look what happened in the recession. We were up to, so March of 2011, we had 190 foreclosure sales in MLS, right? So there were ones happening at the courthouse, right? So this doesn't track the courthouse ones. So I'm sure it was much higher. So we hit 190 and then we started going down. Look at the last year and a half. How many foreclosure sales do we have per month? 2, 3, 4, right? So anybody who says all these people are going to go into foreclosure, it's like, we don't have any foreclosures, right? Because people have so much equity in the homes, they don't have to foreclose. Even if they can't make their payments, there's other solutions. So I just wanted to share this with you. If you have any buyers saying, hey, the world's going to turn upside down because of foreclosures, it's like, there are no foreclosures here in Charleston.
No.
We're closing 1,600 to 2,000 a month, and a couple of those might be foreclosure. That's it. And I mean, short sales, these were fun ones. So before the recession, and again, I got in the business 2001. I never knew what a short sale was until probably right in here. Right? There was no short sales. And then we were doing 100 of those a month. And then how many are we doing now? Again, with the foreclosures, 2, 3, 4. I haven't done a short sale in a decade, probably. So again, the distressed sales, it's almost nothing. So again, this is something to watch. If we go forward in time, do the foreclosure and short sales start to go up? We're not doing this. Will it go back up to a few? Yeah, but again, you can avoid foreclosure and short sale unless you rob the piggy bank on your house. It's like you should have a ton of equity in your house.
And the recession won't be it's going to be soft recession, right? Mild recession.
And that's what everybody is predicting, but they've been predicting that for a while. And
Meaning
but
though that people aren't going to be in droves without jobs, that
but
they can't.
Jackie made a point earlier, and I don't have the chart with me, but if you look at every recession, what happens immediately after the recession? Interest
Right.
rates drop,
Right.
right? The government drops the interest rates, right? So we are, if the government drops the interest rates, look out, because I think the buyers are going to come storming back even more than they are now. Just because there's nothing for sale and you have to have a place to live. And if rates are 5% and you do the math, even at a higher price, it's still maybe more affordable than renting. So, yeah, and we're always in an interesting time, but it's trying to predict what's coming forward. But I don't see any red flags that are highly concerning to me of our Charleston market. So, all right. Well, everybody enjoy this beautiful weekend. Go ahead and sell a house or two if you can. So
the point, Joanne.
Yeah. And again, recession in the 2008 recession, that was wasn't because of, I'm going to specify, it was because of lending practices, which led the housing market to be the cause of the recession, but it was the lending practices were the root cause of it. And we don't have loose lending right now. It's still tough to get a loan. And I wanted to stay that way. It's okay. So,
and housing is typically a lagger. Joanne said
Correct.
housing will be a lagger, and that's historically what it always is.
Yeah, but if rates drop because of the recession, I don't see where the housing is going to be a big issue, because it's all about affordability, right? And if rates drop, that's making housing more affordable. So,
Yep.
There's a lot of unknowns for the next few years between,
Agreed.
between
We have an election coming up next year. There's a lot of things happening. So,
and I'm just thinking the rental market change versus the interest rates, and that's all gonna, who knows? But thank you, Anton.
Yep. All right. Well, have a great weekend, everybody. We'll do this again next month.
Okey doke.
Bye.
Bye.
Bye.